Okay, so in this video, you'll learn what is Forex trading and how does it work. So what exactly is Forex? So Forex stands for foreign exchange, right? FOR goes with foreign and EX is exchange. So when you hear the term Forex, you're basically referring to foreign exchange. So Forex trading is simply the trading of one currency for another, right? So this is something that I would say 99% of us have at least one point in time, right, dabble in Forex. May not be, electronically, where you are going long or short, but physically, when let's say you're going for a holiday, right? Let's say I'm in Singapore and I'm going to Malaysia for a holiday. So if I want to go to Malaysia for a holiday, I need to spend Malaysian ringgit in Malaysia, right? If you go to US for holiday, you'll spend USD in US. So in order to get Malaysian ringgit, I need to sell my Singapore dollars for Malaysian ringgit. So this is one form of Forex trading, right? You're selling your own domestic currency for a foreign currency. So you can spend that currency in the foreign country that you're visiting. So this is one form of Forex trading. So who trades Forex and why? So Forex is largely traded by banks, like central banks, corporations, and retail traders. So just let me briefly explain to you, why they get involved in the Forex market. So for central bank, it's usually meant to intervene the FX markets. Perhaps, their currency is appreciating too much and they want to, remain competitive for their exports. So central bank can intervene in the FX market. For example, in 2012, you have the Swiss franc, right? Pegged against the euro because the Swiss franc was appreciating too much against the euro, and the central bank intervened and pegged the euro at 1.2. So this is an example of the central bank intervening in the FX markets. Then you have banks, right? I know Deutsche Bank, Goldman Sachs, HSBCs, right? Where they trade Forex, but as a form of market making to provide liquidity to corporations, and as well as to hedge their book, right? In case they have any currency risk, right? These banks will also trade the forex market. But the thing that I want to point out is banks and corporations, they have close working relationship, because for corporations, right? Let's say, for example, you are a car maker. Let's say I'm a Toyota, right? I manufacture cars. But the thing is that my car spare parts are not found in Japan. I may have to go to countries like maybe China or India to source for these spare parts. So if I'm the car maker Toyota, all right, and I need to buy these spare parts, or rather to buy the raw materials to manufacture my car, I need to get them in the foreign country. So what I'll do is that I will sell my own country Japanese yen for, say, the Indian rupee, right? So I got the Indian rupee and I can go to India and buy the relevant materials that I need. So this is another form of Forex trading for corporations, where they typically, sell their own domestic currency, right? And in exchange for a foreign currency to buy, whatever relevant spare part, raw materials that they need. So this is, how corporations, dabble in the FX markets as well, right? They also dabble in the FX markets to, hedge whatever positions that they have that could be, exposed to currency risk. And last but not least, you have the retail traders like me and you who speculates in the Forex market, right, to earn a profit, right, and this is something that, and I believe this is the reason why you're watching this video right now, to learn how to trade the Forex market. So this is where retail traders come in. So one thing to note, right, I want to share with you the hierarchy, right? So it's no, this is the map. Let me share with you the how it all works, right, this ecosystem. So you can see over here, central bank are the largest, right, over here, and then they followed by all these major banks like Deutsche, Goldman, JP Morgan, and whatsoever. So all these major banks, they have relations with investment funds, commercial company like Toyota, Cadbury, stuff like that, or maybe say hedge funds and who wants to trade in the FX market. So all these banks, right, they typically have connections to commercial companies and large funds or large speculator. And on top of it, right, they also have connections to market maker, right, where you trade from your broker, right? They have connections to your broker, right? Okay, market maker or ECM broker and stuff like that. So from then on, right, this is where your own broker have connection to you, the retail trader, through their own trading platform. So this is how the ecosystem work, right? Banks would communicate with your own retail brokers, commercial companies, or investment funds, right? It does not mean that they will dabble in all three categories, right? For the banks, right? Some of them may just choose to focus on investment funds, some to focus just on commercials company, or maybe some can have dealings with all three different categories. Okay, so but you as the retail trader, you only have access with the connection with the market maker, who then might pass on your order to the bank connection directly, may or may not, depending on how your broker established their trading system. Okay, so with that said, right, this is the ecosystem. And to look at the hierarchy, right, this is a source from Baby Pips, right. You can see that major banks, they are at the top, right. They deal with the most number of they put in the largest orders, right, and they typically communicate with one another using this system, right, the EBS system. Okay, and then further down the food chain is where you have your your retail market makers, right, the brokers, the ECNs, right. And this one over here, they put it hedge funds and commercial companies at the same level. But to me, I would say this group of traders are typically one level above retail trading, right? I would say somewhere around here, where there's hedge funds and commercial companies. And last but not least is retail traders like you and me, who trades the FX market. So this is the food chain, right? It's a fact, right? So this is why retail traders, right? You don't move the market. The markets are usually moved by the big players, which I shared with you over here, right? At the top of the food chain. So moving on, what are the advantages of Forex trading, right? Number one, high liquidity, right? So whenever you put in an order into the Forex market, you don't have to worry about, getting a poor price or slippages, because there is usually huge amount of liquidity, and you pretty much need to enter really large lot sizes to even move the market. So you don't have to worry about, whether you get filled or not. Chances are, when you hit the market, you pretty much get a price which is close to, what you see on your screen. Second thing is low barrier to entry. So this means that anyone can join or trade the Forex market, right? Unless your country sort of like ban Forex trading. But if not, right, what's there to stop you from opening an online account, right, and just submit the necessary paperwork, and you can be trading Forex. The third thing is better risk management. Why I say this is because Forex allows you to trade very small lot sizes, right? You can trade up to micro lot or even nano lot. These are really small lot sizes that allows you to better manage your risk. Unlike stocks, right? Like for example, you buy say one share of a blue chip stock, or in Singapore, right? You have to buy at least one lot. Right, that was I think some time back in Singapore, you want to buy one lot of shares is at least 1,000 shares. So if your account size is too small, you can't even buy one lot of shares in Singapore. So compared to Forex, right, you have better risk management because they let you trade really, really, really small sizes. And then you have trade anytime you want. Forex is traded 24/5, right? Monday to Friday. So you can wake up in the Asian session, put in an order, manage your trade, or in the London session, in the New York session, you can pretty much trade anytime you want, right? Unlike the stock markets where it's usually open for 8 hours a day, right? During the respective time zone that you're trading at the particular stock market. And one last thing is Forex trading, you have low transaction costs, right? So in Singapore, right, again, back to reference back to Singapore, whenever I buy say shares, right, the minimum transaction cost to buy is $25. And when I sell, it's another $25. So one thing about Forex trading is that there is no transaction cost. You only usually pay the spread. Okay, you may pay transaction costs depending how your broker want to charge you. But typically, right, you don't have to pay transaction costs in Forex trading. You just pay the spread. So if you think about this, right, in Singapore, let's say I buy some shares worth, let's say, $500. Okay, and one buys is $25, one sell is $25. So before, let's say when I buy the share, right, it's $25. So $500 value, right? Let me just get it down to kind of show what I mean. So let's say, right, I want to buy $500 worth of shares, right? The transaction cost typically in Singapore is $25. So 25 divided by 500, when I buy the shares, this is equivalent to 5%, right? So I'm already down 5% even before the market, even before, the moment I put on the trade, I'm already down 5%. And this is still not taking into consideration the spread on the trade that I've paid, right? I've not included it here. But for simplicity's sake, what I'm trying to say is that when you trade stocks, if you have a small account, or rather you're buying a small number of shares, a small nominal value, that fixed transaction cost will eat into a huge percentage of your returns. So for this, right, you're already down 5% from the start for stocks. Whereas for Forex, right, you don't have this so-called transaction cost. You only pay the spread, which is something that we will talk about later. So this is one of the advantages of Forex trading as well. So just a quick recap, right? Forex trading is the exchange of currencies. Right, it's traded by banks, corporations, and retail traders like you and me. And the advantages of it is, it has high liquidity, low barrier to entry, better risk management, you can trade anytime, and it has a low transaction cost. Okay, so with that said, I have come to the end of this video, and I'll see you in the next.